Hi, I'm Justin Hales, the founder and president of Green Rock Consulting. In this video, you will learn how to take the profits that a bank is currently making from your real estate investing loan activity and divert those profits back to yourself so that you can buy more properties and have more profitable properties by becoming your own banker using our velocity banking concept. If you'd like to schedule a discovery call with us to learn more about how to apply this to your life, fill out the information below or email us at hello@greenrockconsulting.com. We look forward to speaking with you.
Today's video, we're going to quickly demonstrate the power of becoming your own banker through our velocity banking concept for real estate investors and real estate situations. So let's look at a scenario. Let's just say we're dealing with, this is scenario A. You're going to deal with, let's just say it's a $1 million property, just for nice round numbers. Now, how is one going to finance this thing? Depends on what it is, but let's just say that you're going to need $300,000 down in this case, and you're going to finance through the bank $700,000. And let's look at what this is going to cost you. Now, the $300,000 down, a lot of times people would say that that doesn't cost you anything because you're paying cash. Well, I don't agree. If you've watched our other video about how you finance everything, either way, whether you pay cash or whether you finance it, what you'll know is that with that $300,000 you put down, what it means is you are now giving up the ability to earn something with that money elsewhere. And we know that there are reliable ways to earn good interest. So I think it's reasonable to assume that you could earn at least 3% on that money. So we're going to assume that that's a cost to you. That because of that money down, you are giving up $9,000 a year, and that's just the first year. That's 3% of 500 or 300,000. Now let's say you're going to finance the other 700,000, and let's just say you're able to secure a great rate of 5%. That is $35,000 in interest. Now, we know that that loan is going to be, the interest is going to be tax deductible. So let's just figure tax, and let's just say we're dealing with 40%. So you're going to get 35,000. You're going to get 40% of that back in the form of a tax deduction. Let's just assume, and look, we're not giving tax advice here. Talk with your CPA about this. It's just, that's my understanding of what it is they're going to tell you. Okay, so there. So we have 9,000 and 35,000 is 44,000. Less the 14 you're going to get back. Overall, this loan is going to cost you $30,000. That's year one. And again, I get that typically these real estate loans are amortized. There's amortization over 30 years, and so really the loan balance drops a little bit every month, and the interest is variable, and it's not that simple, but this is very, very close, just for simple comparison purposes. So overall, just 1 year, the first year, you're looking at a cost out of pocket net of somewhere around $30,000. Now, let's look at scenario B, and this is velocity banking. Now, same property, 100,000. Now, in this case, when you are acting as your own banker here, and you're using your velocity banking policy, do you need to put any money down? And really, the answer is no. No, you don't. You don't have to do that at all. You can finance the entire thing, assuming that your policy is efficient and you've properly funded it, and there's $1 million available to be borrowed. You can borrow the entire million. And so that would be one way to do this. Another way to do it would be you could still do the financing at the bank, and you could just, from your Velocity Banking policy, you could finance the down payment. That way you didn't have to put anything out of pocket. And that might be a good way to show this too. So, well, in this case, let's just assume that you finance the whole thing. Now, the rate, let's just say, is 5% fixed. And again, for these illustrations, not that this is always what you would do, or not that's necessarily what we recommend. In fact, I kind of believe that this is the least profitable way to do it, but it's the cleanest and easiest to illustrate, and so that's why I do it. So we're going to show a fixed rate of 5% in direct recognition. So it's a 5% loan. Okay, so the loan here is going to be $50,000 of interest. So it's negative 50,000. And again, this loan for business purposes, I think your CPA will tell you that's tax deductible. We'll just deduct it the same. That's interest at the same 40%. So that's $20,000 that you're going to get back in taxes. So you can see already that you're equal $30,000. Now you might say, well, wait a minute. Over here, we docked ourselves 9,000 because the money was used, and so now we're giving up earnings with it. You can see that we're still going to earn money back on this money, so the money's not down. So that's part of why we do that. So let's do that part of it. So in this case, the way that this works with the company that I'm thinking of, 5% direct recognition, they keep 0.5%. That's the spread that they keep, the insurance company keeps for their expenses and processing, which means that of the 5% interest, 4.5% of it is what you get back. So in that case, that's 45,000. So you can see in this case, you are ahead 15,000, where here you were behind. This loan cost you 30,000. That's a $45,000 spread. What's the difference? The difference is here you are profiting from your banking activity in the same way that a bank profits. In scenario A, the bank keeps this money. You give this up when you put the cash down. You give this to the bank and they keep that, and you get the tax deduction back. But in here, it's the same. You're borrowing, you're paying the interest to the insurance company. This is not a loan from yourself. You're using your policy as collateral. You're loaning to the insurance, borrowing from the insurance company. You're paying them interest. But because you are a part owner of the company and a mutual company, dividend paying, you are receiving some money back, and in this case, directly recognized back 4.5% of the 5% that you're paying. And that's the money right here. And yeah, that's $45,000, which again represents 4.5% of the entire picture here. Now, look, if you could add that kind of profitability to every deal that you do, what kind of difference would that make for your real estate portfolio? Also, if you didn't have to put any money down, well, how many more deals could you do? And if you had this kind of profitability, then by the way, notice what we're comparing here is the financing of each of these properties. We're not even comparing the profits of the deal itself. Yeah, I think what you'll realize is that by financing this way, you could do significantly more properties, and you could do significantly more deals, and each one would be more profitable than ever before. This is very, very powerful for real estate investors. So if you want to have a discovery call with us, you want to learn more about how this would apply to what you're up to in your business and the real estate that you're investing in or that you want to invest in, we'd love to hear from you. You can find us on Facebook, Green Rock Consulting, or you can email hello@greenrockconsulting.com. Again, I'm Justin Hales, the founder and president of Green Rock Consulting. We look forward to speaking with you.